So question number 1, I won't give you time to copy. You just take a screenshot. It's just a revision. Explain any 4 types of capital investment projects. Yeah, this was under capital budgeting, whereby we say that there are various types of capital budgeting project. We have divisible project, indivisible, dependent, independent, all that. Mutually exclusive projects, etc. I wanted to ask to see any student asking where is the cat. If someone asks where is the cat, namaanisha hakufanya cat. You are not supposed to be here. Part B of the question. Fujo Tupu Limited intends to invest in a 4-year project whose initial outlay is 30 million. The project is expected to generate the following cash flows at the end of each year. So given from year 1 to year 4. The cost of capital is 12% required. Advise the management of Fujo Tupu Limited whether to undertake the project using number 1, NPV. Now let's start NPV. So this is question 1B. NPV is the difference between the present value of cash inflow and the present value of cash outflow. Then we have the cash flows. Year 1, we are generating an amount of 12. We have 15. And then you discount present value interest factor at 12%. So the cash flows are not the same. So therefore, we use the first table. Let's go to the first table. Year 1 is 0.8929. We have 79. We have 7. We have 60. Now give me the present value. $10.7. 0.8. Let's just round off to make our work easier. This one is 958. The last one is 38. 13. 6406. Now add the total. Give me the total present value of cash inflows. You get an amount of that's 92. Then to get NPV, you raise the present value of cash outflow. How much was the cost of the project? We had invested 30. So therefore, the net present value is that 28, not that 2, but 28. 92. Number 2 of the question. IRR. So how to determine the IRR? So I gave you 6 formulas of how to determine IRR, and you see that IRR is computed depending with the nature of the cash flow. IRR is computed based on the nature of the cash flow. And the last formula we did was in case of unequal cash flow. For example, in this case, it's unequal cash flows. And you see that in case of unequal cash flows, IRR will be computed on a trial and error basis. Trial and error basis by adopting the following step. Step number 1, you compute the project's NPV, of which that's what you have done in required number 1. Then the second step is that if the NPV above was positive, you rediscount the cash flow using a higher discounting rate. But if the NPV is negative, you rediscount using a lower discounting rate. Now, in this case, we had a positive NPV. So we discount the cash flow using a higher discounting rate. Good. So we have the cash flow. Then you discount present value interest factor. Is a trial and error method. Use any rate which is above 12%. I'll use 20%. 20%. By using the first table. Year 2, 69, 440.57, 07, 0.23. Now give me the present values. 99, 99, 99, 99.6. Let's just have it as. Is it 10? Yeah. You're getting 10? 416. And I don't want to see anyone copying. I gave you 2 hours ya kuandika na hakuna kitu muliandika. So now you listen. This is an amount of how much? 6250. Sorry? 51? 36. Year 4? 28? 94. Now let's add the total. We get the total present value of cash inflows. You get an amount of 28,446. Okay. So to get NPV, you raise the present value of cash outflow. The cost of the project was an amount of that. Therefore, the net present value will be negative. Sorry? 1554, which is negative. Now we can be able to compute IRR. So IRR is that you take the raw discounting rate plus the NPV using the raw discounting rate. NPV, the raw discounting rate, you minus the NPV when using the higher discounting rate. Then you take the difference between the higher discounting rate and the raw discounting rate. Our raw discounting rate was 12% plus NPV when using the raw discounting rate was an amount of 2892. Then you take 2892. You minus the NPV when you use the higher discounting rate. Our higher discounting rate is 20% with an NPV of negative 1554. Then you take the higher discounting rate of 20% minus our raw discounting rate of 12%, and that's how we get our IRR. So give me that. Get 17 point? Yes. Take a screenshot. Question number 2. Now, just a question. Do you need to revise that again? To be honest, what you just need is just remember. Sawa. If you go with the mentality lazima nichukue ni revise tena. This is something we did in class. Mwalimu amefanya tena. Actually, for now, you are supposed, even you are not supposed to make any copy. If you are a serious student, go and sit down. Take that card. Now try to remember what I was doing. That's how you understand. Because taking a screenshot, na ukose kurevise, would add any value. Ama ni aje? Yeah. Let's go to question number 2. Maridadi Motors is evaluating a capital investment in automobile sector with an estimated investment of 50 million shillings. They have engaged you as a financial advisor to carry out the project analysis and advise them on viability of the project. Required. As an expert in the field, what will be the features of ideal investment appraisal technique? As an expert in the field, assume we're an expert. So, what will be the features of an ideal investment appraisal technique? 4 marks. Number 1, you have to interpret the question. Once you interpret the question, it becomes very easy, right? Did you discuss about the characteristic of ideal project evaluation technique? We say that number one, it should take into account the concept of time value of. Number two, should use cash flows rather than the accounting pro. And what's the reason? Why cash flow are better than accounting profit? Accounting profit, they are based on financial data, which are subject to manipulation. Are you together? Number three, it should give a clear decision on whether to accept or reject a project. For example, NPV. NPV is very easy because if it's positive, you accept. If it's negative, you reject. Another one should help in ranking the projects. For example, evaluating more than one project. Which one should you give the first priority? PC, and you get your 4 marks. Number B, what are the circumstances under which soft capital rationing may occur in the company relation to capital rationing? Remember capital rationing? Say that capital rationing is the scarcity of investment funds. And you say that there are two types of capital rationing. There was the soft or internally generated capital rationing. The other one was what? Hard or externally generated capital. And you say that the soft, this is the scarcity of investment funds due to actions of the management. That is, the scarcity is due to factor within the control of the management, which include, now that's what the question was asking. It was asking about soft capital rationing. Number one, when the management had already set a limit to the capital investment project. And I remember giving you an illustration here, assuming I'm your CFO. Do you remember that? Telling you to go and stick to your budget. Hiyo mlisikiza lakini hamkukumbuka hapa. Another one was what? When the management refuses to borrow more funds to avoid what? The payment of it. The other one was when the management refuses to issue new shares so as to avoid what? Dilution of etc. But actually this question, online student walipata bio result. Yes, online walikuwa napata. You know, for them no one is monitoring them and they have the notes. So walikuwa na kuandikia. Nimeuliza 2 points wameandika 4. Hao ni machopi, right? Kivyao. But the physical student, because there was someone alikuwa anamwangalia, kuwa naweka dash. Number 4 of the question should be number 3. Sorry, that one should be number 3. The following details relate to the capital project in XYZ Limited. We have the project cost, annual cash flows after tax, project economic life, required rate of return, required IRR. I repeat again, IRR is computed depending with the nature of the cash flow. And we discussed about in case of annuity cash flow to perpetuity, in case of a 1-year project, in case of a single cash flow at the end of period N, in case of equal cash flow or in case of annuity for a specific period of time, in case of unequal cash flow, they should be at your fingertips. Now look at that question. Now, which cash flow characteristic is that? Wenye walipata kwanza online student, wenye walipata hii swali wanijibu saa hizi. In case of, correct, Joy is correct that in case of annuity cash flows for a specific period of time. In this case, we are given the annual cash flow is 21 million. Project economic life, 5 years. So you're given an annuity specific for 5 years. Now that's the first step. Once you're able to identify the cash flow characteristic, the next step is which formula do you use? We say that in that case, IRR will be the present value of cash outflow you divide by the annuity. The present value of cash outflow is the project cost, which is 65 million. You divide by the annuity, the annual cash flow is 21. So how much is that? Give me into 4 decimal places. You get 3.0952. But this is not IRR. This project is for how many years? 5 years. Good. Now let's go to our annuity table. We go to our annuity table. Let's go to our annuity table. Annuity table is a second table. Are we there? And now let's go 5th year to year 5. We go to year 5. And then you look across, you check across where we have 3.0952. 5th year, we check across where we have 3.0952. Then you give me the rates. Kama haiko. Sawa. But in between some given figures, that's what I need. If nauliza staki the space. You forgot what we did. It's between 18 and? All right, that's what I need. Between 18% and? So IRR is in between. Now, at 18%, what are you getting? 7.2. At 20%? 0.06. Then our IRR we needed was 3.0952. So what does that mean? So that means our IRR will be between 18 to 20%. So how do we get a specific rate? You say that you take IRR minus the lower limit, then you take the upper limit minus the lower limit. So you'll be taking IRR. Our lower limit is 18%, upper limit is 20%, lower limit is 18%. Then we say that we substitute. IRR, the rate we have is 3.0952 minus at 18%, we have is 3.1272 divided by at 20% is 2.9906. At 18%, we have is 3.1272. So IRR minus 18 will remain to be IRR minus 18. The difference between the upper limit and the lower limit, 20 minus 18, you get an amount of 2 will be equal to, now compute this. 0.23, 43. Good. Now, can you be able to get IRR? So to get IRR, you cross multiply. So it will be IRR minus 18. 2 times that one, you get 0.468. Right? Now, can you be able to get IRR? Yeah. You take this to the other side. It will be positive. So it will be 18.4686%. Number 2 of the question. The profitability index. Now, profitability index is the relative measure of performance, which indicates the relationship between the inflows and the outflow. How do we get PI? Is the present value of cash inflows you divide by the present value of cash outflow. To get the present value of cash inflow, this project is for 5 years and is generating an annuity, 21 million. Present value interest factor of an annuity, the required rate of return is 12% for 5 years. So it's 21 million, 3.6048. Now, note that 21 million was an annuity. So using the second table, take the annuity, you discount, and give me the present value of cash inflow. How much is that? You get 70.70. Good. Present value of cash inflow is 75.70. You divide by the present value of cash outflow, which was an amount of 65. You get 1.16, right? Number 3. NPV. So how do we get NPV? is the present value of cash inflow, you raise the present value of cash outflow. Present value of cash inflow is 75.70, 65, you get 10.7. Now, before you take a screenshot, if you are to advise them based on IRR, accept, reject the project. Should we accept or reject the project? Accept. Why? Yeah, since IRR was greater than the cost of capital, which was 12%, right? Based on the profitability index, should we accept or reject? Why? Because it's greater than 1. NPV, this one you know. Should we accept or reject? Since NPV is what? Screenshot, 30 seconds. Question number 4. Question number 4. Consider the following project, which is expected to generate the following cash flows. So given that, if the cost of capital is 10%, determine the total present value of the cash flow. 6 marks. Yeah, this is time value of money. So we have the period, year 1 to year 4, year 5 to year 9, 10 to perpetuity. Then we have the cash flows, an amount of 50, an amount of 90, an amount of 40. Now let's discount. Present value interest factor, or what we just need is the present value factor. Now, year 1 to year 4, that's a period of past 4 years. So therefore, it will be present value interest factor of an annuity. The cost of capital is 10% for 4 years. So let's use an annuity. That's an annuity cash flows. You get 3.99, So now give me the present value. You take 50, you multiply by 3.1699. Wait, 158? 495. What about now? Between year 5 to year 9. Those are how many years? It's not 4 years. How many years? Good. How do we get the present value of differential annuity? So that you take the present value interest factor of an annuity, 10%, you take the maximum period, which is 9, you minus the present value interest factor of an annuity, 10%, you take the minimum period minus 1. So 5 minus 1, you get 4. So that now if you take 9 minus 4, now you get the present value for the 5 years. Let's go to our annuity table. 10% for 9 years. 75? 90. 10% for 4 years. Give me the difference. $2.5891. Good. Then you take 2.5891, you multiply by 90. You get an amount of 233? 019. Then last 3, from year 10 to perpetuity, how many years are those? Infinity years. So in that case, you'll be taking the present value interest factor of an annuity, 10% to perpetuity. You minus the present value interest factor of an annuity, 10%, you take the minimum period minus 1. 10 minus 1, you get? I have present value interest factor of an annuity to perpetuity. How do you get that? Correct. 1 over R. That's very correct. Our R is 0.1, which is 10%. Then you raise 10% for 9 years is 5.7590. 1 divided by 0. This is 10, right? Can you take 10 minus 5.7590? Get 4.241. And then you multiply by 40. 1? 640. Now give me the total present value. Total present value. 561? 150. Oh, good. Take a screenshot. Now let's do the other one. Question number 5. Now, question 5, you're told that Tyson borrowed 15 million from Baraka Limited at an annual interest rate of 16%, repayable in 4 equal annual installments at the end of each year. Required. Prepare our own amortization schedule. That's very simple, right? Yeah. First of all, you need to determine the installment payment. How much will be Tyson be paying? Is that how do you get the installment payment? Yeah, amount borrowed. You divide by the present value interest factor of an annuity. The interest rate is 16%, right? For a period of how many years? 4 years. Tyson borrowed an amount of how much? 15 million. And now let's go to our annuity table. 16% for 4 years. You get an amount of 82. Now, how much will Tyson be paying each year? $53, 64, 5, 583, 8, 89, eh? Good. So from there we can prepare. This is 360. 53? 60. Not 64, 60. So now let's come up with our own amortization. It's the same as there is amortization schedule. So it's for 4 years. Then we have the opening balance. Subtracting interest at the rate of 16%. And then there is payment. You get the principal. Balance carried down. Is that understanding or coming? But the objective is one, right? To get it correct. The balance brought down is the amount borrowed. You see that the amount borrowed today will act as the present value of the cash flow, of which he borrowed an amount of how much? 15, which will be attracting an interest 16%. It can't be 24,000. Just take 15 times 16. What do you get? 2.4 million, right? Then the payment, you see that the payment is an annuity. This amount Tyson will be paying each year. So therefore, it's an annuity, 5360. Now, of the payment made, it's comprised of two elements, the interest and the principal. Now, if this is the amount he paid, which is inclusive of the interest, if you eliminate the interest, you're able to determine how much was the principal. Principal is the one that reduces the debt. Are you together? Yes. So take this, you minus that. You get 29? 2960? 589, eh? Now, the principal is what to reduce your debt. How much had you borrowed? Yeah, so you'll be taking the balance brought down, you deduct the principal. You get an amount of 12? 12? Sorry? Okay, 12? 039 or 11. The balance carried down becomes the opening balance, so we'll be having an amount of 12, 039 for 11. Now that's what would attract the interest second year. 16% of the answer? 305, eh? 306. 306. Now take what you paid, eliminate the interest for the period to determine how much was the principal. You get an amount of 34? 283. Now take the balance brought down, you deduct the principal to get the balance carried down. Sorry? 120. The balance carried down becomes the opening balance. We'll be having 8605, 128, and 16%. 13? 13 what? 376? 820. Now take the payment, eliminate the interest to determine the principal. That 9? 83? 69, eh? Now let's take the opening balance. You deduct the principal for the year. Eh? 359. The balance carried down becomes the opening balance. 4621, 359. 739. 418. Principal, you minus that to get an amount of 4621. 4621. 171. 359, you minus 171. Yeah, you not get 0, but you equated to 0. Yeah, because the balance you're getting is immaterial. Can take an evidence. That's the number 6. That's where most of you wrote nothing. The management of Kuja Twende Limited wishes to establish the amount of financing needs for the next 2 years, ending 30th of June 2025 and 2026. The statement of financial position of the company for the year ended 30th of June 2024 is as follows. And so we're given the statement of financial position. Added information. For the year ended, required. Determine the amount of external financial requirement for the 2 years ending 30th of June 2026. 8 marks. Then number 2, prepare a pro forma statement of financial position. Now we did this under financial forecasting, whereby we discussed two methods: cash budget, the percentage of sales method. What do we say about the percentage of sales method? Do you remember the steps followed? Yes. Because this is what we are doing. See that under percentage of sales method, step number one is you identify the balance sheet item, which will vary as sales vary. That is the non-current assets, current liability, and the retained earnings. That's the first step. Identification of the balance sheet item, which will vary as the sales varies. Number two, you express those items as percentage of sales. The third step, once you get the percentage of sales, you take that percentage of sales, you multiply by the incremental what? Sales. You multiply by the incremental sales. And then lastly, you determine the external financial requirement. So determining the external financial requirement. So the first step, we identify the balance sheet item, which will vary as the sales varies, which include the non-current assets, and then the current assets, whereby we have the inventory, we have receivables, and then we have cash. Also, we need the current liability, whereby we have the trade payables, we have the accrued expenses, and then you factor in the retained earnings. Simple. That's the first step. We identify the balance sheet items which varies as sales varies, which include non-current assets, current liability, and the retained earnings. Then the second step, you express those items as percentage of sales for that period. And non-current asset was an amount of 187,200. This was an amount of 57,600, 43,200, 10,800. Payables, we have 54, we have 36, but for the retained earnings, we'll be using the actual amount. So when expressing those items as percentage of sales, but only for the retained earnings. For the retained earnings, we'll be using the actual amount. Additional information number one. For the year ended 30th of June 2024, sales amounted to 360 million. So these are the items, you divide them by the value of the sales. Remember, our figures are in thousands, and the sales was in millions. Yeah, this is what we mean by expressing those items as percentage of sales. The first one is 52. This one is? Yes? 16%, 12%, 15%. And I hope you're not rounding off. You are giving the exact percentage. 3%. This is 3%. Now that was the second step. What was the third step? You multiply the percentage of sales by the incremental what? So now we need to get the incremental sales. Note number one, for the year ended 30th of June 2024, sales amounted to 360 million. Sales are projected to rise by 15% in the year ending 30th of June 2025 and 20% in the year ending 30th of June 2020. Those are 2 years. So how much will be the incremental sales for the 2 years? So expected sales 2025, 2026. For this period, it was an amount of 360. We are told that sales are projected to rise by 15% in the year ending 30th of June 2015. So you multiply by 115%. So how much is expected sales? Get 4? Then, and by 20% in the year ending 30th of June 2026. So you'll take 414, then it increase by 20%. So you multiply by 120%. You get? 496,800. Therefore, how much will be the incremental sales for the 2 years? You just take 496,800 from 360. How much will be the incremental sales for the 2 years? $136. So this will be the incremental sales for the 2 years. So once you have the percentage of sales, you multiply it by the incremental sales of 136,800. No, you don't do for different years. If you did different years, that will be totally wrong with a lot of work. Yeah. Sorry? What if you had the 15? You had 15 and the 20%. There is nothing like that in accounting. You take 15 and 20, that would be very wrong, because if you take that, 15 and 20, you'll be subjecting only the 60, which is increasing. But these are different here, whereby this 20% will not be based on 60%, average 60. It's based on 14. Compounding. Are you together? Yes. Give me the values. The first one is 136. 21. 888. Others will be computing for cash, others payable. This is 16, 416, eh? 4104. 25. 520. Now we need retained earnings. How do you get the retained earnings? Very simple, right? Yes. Note number 2. The after tax. Nani umefungua simu? I can see my echo somewhere. The after tax return on sales is 8%. That's what we call the net profit margin. So up to that point. So from what we have here, let me just do it separately. Determining the retained earnings for 2025-2026. We already have the expected sales. This is 414, and this is 496,800. But now we are not interested with the sales. What we need is the retained earnings, of which we are told that the after-tax return on sales is 8% after tax. That's the net profit margin. The net profit margin, it's 8%. So that means if you take the sales, you minus all the expenses, including the tax, you'll get a return of 8%. So how much is the expected retained earnings? Not retained earnings, but net profits. Sorry? 120. What about this? That's 9,744. Now, those are the expected net profit. But you're not interested with the net profit. What we need is the retained earnings. Then you're told that, we are note number 2, that the after-tax return on sales is 8%, which shall be maintained in the future. And the entity has a dividend payout ratio of, dividend payout ratio is 80. So we'll be paying 80% as dividend. How much do we retain? Just need the 20%. So this one will get 6624, right? That 974.4 times 2. 79. 89 point. Yeah, there is 0.4. Don't out of this. 79. 0.8. Now, can you give me the incremental retained earnings for the 2 years? It will be an amount of 14.5. 572.8. So the retained earnings is 14,572.8. The next step was you determine the external financial requirement. External financial requirement is the amount the entity expects to borrow over the coming 2 years. How do you determine that? You take the increase in in assets minus increase in liability as well as retained earnings. So add assets minus liability and the retained earnings. So this will be the external. $64. 771.2. Number 2, a pro forma statement of financial position. Pro forma, we say that is more of the forecasted financial statement for the year ending 30th of June 2026. So I think that don't prepare for 2 years. They are very specific. They just need for 1 year. Kuja twende limited. The forecast statement. So just copy paste what we have there as the format of the statement of financial position. And starting with the assets, we have non-current assets. Non-current asset was an amount of 187,200. You add the expected incremental non-current for the 2 years, which is 71,136. So get 158, right? 250. 250. 336. And then we have the current assets. For the current assets, we have inventory. We have receivables. We have cash. This was an amount of 57,600, 43,200, 10,800. Then you add the incremental element over the 2 years, 21,888, 16,416, 41,04. This one you get an amount of 78, no, 79? 488. 59? 616, right? And 10, 14, 4904. Now give me the total assets. What are you getting? Sorry? 412? 344, eh? Equity and liabilities. We have the ordinary share capital. And you see that the ordinary share capital does not change when sales changes. So therefore was not factored here. So therefore that will remain constant, an amount of 126. And then we have the retained earnings. The reserve, 52,800. Then you add the incremental retained earnings, an amount of 14,572 point. You get 70? No, you get 60? 67. 372.8. Then we have liabilities, non-current liabilities. And current liabilities, we have a 12% long-term debt. An amount of that one does not change. But the external financial requirement that this is the amount the company needs to borrow. If they expect to borrow, therefore becomes a liability. So you factor in here the external financial requirement, which was an amount of 64.1.2. Lastly, we have the current liability. Current liability. Trade payable was an amount of 54. Then you add the incremental element of that 680, 50, 60, get 67, 680. It was, no, it was 2520. Yeah, it was 2520. So we get 74, 520. Then we have the accrued expenses. Accrued expense was an amount of 36. Then you add the incremental element of 13, 680, 30, 40. Is it 49? 49, 680. Give me the total. Get an amount of? Yeah. This we have only done it with 49 minutes. There is no formula. You just need to understand what I have done. Where is Shira? Now my question is, how was that cut? Was it fair? Yeah. It was very fair. You see that? Yeah. I cannot deal with the question. I told you that, okay, for now, based on the first perspective, according to it was hard. When we revise, saizi imekuwa fair. Si kweli? Na imekuwa simple. Now, can you imagine yourself, by the time you are doing your exam, you have done like these 3 cuts. Who is to benefit? Is it me or you? But sasa nikimwambia kuna cut, that's the time kutafuta excuse. Sitapatikana. This is part of your academic success. I'm trying to offer you, as your academic parent. Wengine wanakata. That's the only time munapotea. So I'm trying to do this for your own good. And you'll be having another cut. The first or the second week of March. Have another one. Then once done with the syllabus, we do a mock. We do them, we revise. Kama hamtaki mimi sina shida. Mimi, I told you that it's time for me, by the way, to set this card. The figures, the name of the company, preparing marking scheme, marking, because that zenye zenye sijamark nitamark. It's time, and I have to sacrifice my time. Yeah. Na wengine kazi inakuwa hawafanyi, kazi yao ni kukaa tu kuitisha solution. Wala mtu kama unajua you never did and submitted the cut, usiniitie solution hata kidogo. Itisha kwa group, it will be given by the other students. Because there are those students who always, I always say that, kuna those students, whenever you give them an assignment, wanatumanga. I told you that, huyo student hata anisubue saa ngapi nitamsaidia. Because for me, I'm here like a teacher. Nimsaidia, I'm your mentor when it comes to matters CPA na matters finance. So kama if you are good follower, mimi sina shida kukusaidia. Hebu angalia yenye huwa anatumia assignment. Kuna mtu unapata ametuma saa 6 usiku. Anakwambia imenilemea. Huyo tunatafutanga time na note mahali, when I have free time namsaidia. Mwingine anakuja hata hajai submit any, anakwambia solution to November 2016. Sasa and kindly note that for me I don't give solutions. Tuko pamoja? Because there is no you can tell me solution to November 2016. Number one, I don't know the unit you are taking. I'm teaching 7 units. Sijui ni gani. So una assume nisimame mahali niko nitafute past paper niangalie nikufanyie. That one I cannot do. Whenever I give an assignment, do assignment, submit, nikwambie the figure this was wrong. From there naweza kusaidia na solution. Lakini si ukae hapo, they give me the solution of the assignment you gave. Wewe umesubmit. Sawa.